Hi class, I'm happy to be with you again today. I've got my technology problems figured out and I'm going to work several problems from Chapter 9 today. So first let's take a look at SE2, Chapter 9, SE2, page 356. So the big thing about this chapter, the most important thing about this chapter, is that we get a grip on how to deal with the allowance for uncollectible accounts, okay? The big deal here on accounts receivable, you have been making entries for accounts receivable for quite some time. You are very well versed in, we sell something to someone, we debit accounts receivable, we credit sales. What we're interested in this chapter is valuation, because your accounts receivable are not really worth the total balance, unless you're one of those rare companies where nobody ever stiffs you on your bill. But most people are going to have some percentage of their accounts receivable go bad, so to speak. You're going to find out that somebody's not going to pay you, okay? And I don't know why this is kind of out of focus. It's driving me crazy because I have not moved my hand, so it should focus and be fine. Okay, so we have two ways that we do that. One is that we use the accounts receivable balance method. The other is that we use the sales method. We don't use both. A company uses one or the other, okay? If I use the sales method, that means that I have some history and experience. Maybe I know that 1% across time, on average, 1% of my sales have ended up not paying me. Well, so in advance of even knowing who they are, we go ahead and we set up a reserve for that. So in other words, we are going to debit bad debt expense and credit the allowance for uncollectible accounts. Actually, your author doesn't call it bad debt expense. Your author calls it uncollectible accounts expense, which I will tell you is ridiculous because everybody in practice calls it bad debt expense. So excuse me if I go back and forth between the terms. So in the sales method, it doesn't matter what our balance is in the allowance for uncollectible accounts. Doesn't matter what it is. We're going to book the expense based off the percentage of sales. When we use the accounts receivable balance method, that company says, okay, we've got X amount in accounts receivable, and we believe from looking at the aging, which is where we make columns and actually show which of our accounts are overdue, and then we look at those overdue ones and we think, okay, some of those are not going to pay. Maybe we find out in the newspaper that they've gone bankrupt or whatever. We look at the balance in our allowance account that's left in there from last year, and we adjust it to get to a desired balance in the allowance account. The allowance account has a credit balance. It is very similar to accumulated depreciation in that it is a contra account to accounts receivable. It is not a liability. It has a credit balance, but it needs to stay over with the assets on your balance sheet. It is a contra account against accounts receivable. So let's go ahead and take a look at SE2, SE3, and SE4, which show the differences between the methods that a company might use. Okay, so SE2 says that during the first year of operation, Brown Sales Corporation made most of its sales on credit. At the end of the year, the accounts receivable amounted to $199,000. Okay, now, this is a brand new company, so they've got a beginning balance in the allowance account, the allowance for uncollectible accounts, of 0. Okay, so if they use the accounts receivable method, they're telling us that we know what we want the allowance account to be at the end of the year when we get ready to do our financial statements. Okay? They tell us $16,500 of the $199,000 of accounts receivable are estimated to be uncollectible. What adjusting entry would be made? Well, so they're telling us that they think we need to reserve for $16,500 going bad. So we need to make the entry that will get the allowance account to the right place. So since this is our first year and we have a zero balance, then we have to make an adjustment for the whole $16,500. So I'm going to debit uncollectible accounts expense for $16,500 and credit the allowance for uncollectible accounts, which I'm not writing all that, $16,500. The idea here is that the sales that generated these accounts receivable happened in this year, and so we need to match our estimate of the bad debt expense in the same year that those sales happened. That's why we book it based on estimate ahead. Okay? So let's hop down and look at SE3. Okay? At the end of October, Santa Fe Company's management estimates the uncollectible accounts expense to be 1% of net sales of $1,385,000. Prepare the journal entry to record the uncollectible accounts expense, assuming the allowance for uncollectible accounts has a debit balance of $7,000. Out here, I'm going to put the allowance and what it looks like now. It has a debit balance. People might say, how could it have a debit balance now? Well, it gets a debit balance if you actually end up having to write off more accounts than you estimated. Because when we use a reserve system like this, when we find out that somebody did file bankruptcy or something and they're never going to pay us, we don't book the expense at that time. We already booked the expense when we estimated it and we set up the allowance. So when we find out that we're going to have to get rid of an account because they're never going to pay us, we debit the allowance account and credit accounts receivable to remove that customer from our records, okay, to remove them from the accounting records. So your allowance account can get a debit balance because you ended up having to write off more accounts than you thought you would have to, okay? Now, SE3 is on the sales method because they didn't even tell us what the accounts receivable balance is. So we need to take 1% of $1,385,000. Okay, 1% of $1,385,000 would be $13,850. This is the expense. When you use the sales method, we're not trying to get the allowance account to a certain point. We're actually basing the expense on the amount of sales. So no matter what is in the allowance account, we are going to book $13,850 in expense. So we're going to debit uncollectible accounts expense for $13,850, and we're going to credit the allowance for uncollectible accounts for $13,850. So see, when I put that book that $13,850 into the general ledger, that's going to get our allowance up to $6,850. It doesn't matter. It doesn't matter that that balance is not as much as we booked in expense because we matched the expense to sales directly on the sales method. Okay. Now let's contrast that with SE4. Okay, so this is Chapter 9, SE4. Yeah, I can do this in 6 minutes. I don't want our videos to get too long. An aging analysis on June 30th of the accounts receivable of U to Z Door Corporation indicates that uncollectible accounts amount to $86,000. Prepare the journal entry to record uncollectible accounts expense under each of the following independent assumptions. Okay, so they looked at their accounts receivable and they decided that the allowance account needs to have an ending balance of $86,000. They decided that we think out of the accounts receivable balance now, we need to reserve for a potential of $86,000 to go bad. So, to know what the journal entry should be under this method, I need to know what the balance is now. Well, it says that the beginning balance for Part A is $18,000 credit. So, I need to make an entry to get it from $18,000 to $86,000. And the difference between $86,000 and $18,000 is $68,000. Okay, see, it takes $68,000 to get my account where I need it to be. So I'm going to debit uncollectible accounts expense for $68,000 and credit the allowance for uncollectible accounts for $68,000. Okay, then on B says, well, what if there was a debit balance of $14,000? Well, how did that happen? Well, we wrote off more people last year than we thought we would. So we're starting out with a debit balance of $14,000. I want to get it to a credit balance of $86,000. So I'm going to have to make a bigger adjustment because $14,000 would just get me to zero. And then I got to get on to $86,000. So $14,000 plus $86,000 means that I would have to credit $100,000 to get a debit of $14,000 to a credit of $86,000. Everybody see that? Okay, so I'm going to debit uncollectible accounts expense for $100,000 and credit the allowance for uncollectible accounts $100,000. Okay, so that concludes SE 2, 3, and 4. I'll start a new video to do some more problems. Thanks.